In 2008, Derek was on top of the world. He'd built a real estate empire, and he'd made millions doing it. On a ski trip, tragedy struck, and a snowmobile hits him, shatters his femur. He's in the hospital for months. All he can do from his hospital bed is watch the market crash and his empire collapse. In a matter of months, he lost millions of dollars. Bruce and Amy weren't just married, they were business partners, and they were good at it. They made millions until Amy decided that she no longer wanted to be married to Bruce. Their $10 million plus portfolio transformed to $4 million each overnight. Mike was the serial entrepreneur. He trained others on how to build their brands, tell their stories, but he didn't like doing things the way everyone else did them. The way he invested was by listening to those he trusted most, other entrepreneurs. He'd listen to their pitches, he'd hear their vision, and if he connected with them, he'd invest. This cost Mike millions of dollars, both in the investments he made, because they always failed, and in what could have been had he invested in other things. Who's this? Oh, there we go. Alex is she from the ground up, she built a $100 million company. She thought she was going to have a $100 million company forever. A few years later, $100 million company, gone. She made $100 million, lost $100 million. She thought she was building wealth, and in an instant, at least in her mind, it was all gone. This is Chris. Chris is a multiple millionaire business owner. He thought he was doing all the right things, saving 10 to 15% of his income, investing in stocks, doing some real estate. But when it came time for Chris to retire, his assets could only support a $500,000 lifestyle, a far cry from his $1.5 to $2 million current lifestyle. All of these stories are common amongst business owners and entrepreneurs. Entrepreneurs make millions of dollars, think they're building wealth, only to realize, often far too late, that all they were doing was making money. High income does not equal wealth. I believe that one of the problems is that there's a messaging problem. There's a phrase that's always followed by something. It's this phrase: "This is what the wealthy do." And then it's followed by, make money in your business, invest in real estate, or use life insurance, or make this diversified portfolio, or just have a successful business, or do index funds. It's always that phrase, this is what the wealthy do. And it makes us believe that if we do those things, even if we're just dabbling in them, that we're actually building wealth, when in reality, we're not. And it leaves people disappointed. So if we're actually going to know if we're building wealth that's sustainable, we have to actually look inward and look at our behaviors and habits around money. To help you analyze your behaviors and habits, I've created what I call the business owner quadrant. This quadrant will help you see the probability that what you're doing, both inside your business and outside your business, will actually create and produce sustainable wealth. The more you shift away from being an owner-operator, and the more you become an owner-investor, the higher your probability becomes. Now, it's easy to view this chart in terms of business ownership. Like, everyone can see that. Like, I've been an owner-operator. Many of you probably were an owner-operator. You know what that looks like. You can see it. But if you're an owner-operator, the chance of you selling your business is next to zero. If you're an owner-investor, on the other hand, like Mike Fata is an extraordinary example of becoming an owner-investor. Like, he meets that criteria, was what he's created. Like, you have a chance to sell it, and it can become profitable. So in your business, you need to shift from being an owner-operator to becoming an owner-investor. But you want to also make this shift in the way that you handle everything else financially. Because you could be an owner-investor in your business and be an owner-operator in the way you handle your taxes, in the way that you handle your investments, in the way that you handle your insurance, in the way that you handle your cash flow. And that will produce the exact same results that an owner-operator in a business would produce, which is a very low probability of actually creating wealth. In all of those stories that I told, they were either an owner-operator with employees, or an owner-leader, either in their business, outside their business, or a combination of both. And in each of those stories, they didn't actually create wealth, they were just building money. Is where we got to make the transition to is we need to become owner-investors. Owner-investors are the ones that behave and have the habits necessary to actually create sustainable wealth. Now, at this point, I can see many of you, you're starting to think, you're thinking this through, and you're thinking, okay, this is decent stuff, but is this gentleman ever going to smile? And the answer is no, I'm not. I'm not going to. But the key is that I will smile if you can get me to smile. I really enjoy it, yeah. I enjoy life a lot. I just get really serious. I need to let you know that even though I look like a robot, I actually am very human. So I don't have time today to go over all the different ways of like, here's how an owner-investor behaves, how they do wealth management, here's how they behave in their business, here's how they do this. I'm only going to give you 3 today, but I am going to be here all weekend. My business partner, Derek, who's back there, will also be here all weekend, and you can have conversations with us about different ways that owner-investors behave, so you can start to insert those into your actual behaviors and habits, because that's how you actually create wealth, is by changing your behaviors. I have come up with the 3 that I think are most applicable for the people in this room. The 3 that I think if you started with, you would have a massive ripple effect occur in your life, and you would start to see things happen a lot faster than they currently are. So I want you to picture something with me. Up here on the stage is a track. In lane 1, you have your accountant. In lane 2, your insurance advisor. In lane 3, your investment advisor. And in lane 4, someone that's helping you scale and grow your business. Every one of them is ready to run, and they're gearing ready to go. When the gun fires, the business consultant runs to the left, chasing the latest shiny object. The investment advisor keeps his head down and runs straight ahead, full bore. The insurance advisor is so focused on the past that they run backwards. And the accountant, too afraid to act, freezes. This is the story of most owner-operator tax situations and their teams. They're a disjointed team, and each of those people are running their own race. They're not running your race. There is no communication, there is no collaboration, and it's your dreams and it's your vision that suffers, not theirs. This stands in stark contrast to the way an owner-investor would create a team. And I believe that Steve Jobs tells us the answer and difference between the way an owner-operator and owner-leader's teams are constructed and the way that an owner-investors are. He says this: the greatest people are self-managing. They don't need to be managed. Once they know what to do, they'll go figure out how to do it. What they need is a common vision. And that's what leadership is, having a vision, being able to articulate that so clearly that everyone in the company understands it and is getting a consensus on a common vision. You understand the need to do that in your business. You also need to do that with your advisors that are helping you build and sustain your wealth. So same scenario: accountant, insurance advisor, investment advisor, business consultant. For the owner-investor, when the gun fires, they're all running in the same direction, not for them, but for you. And the solution was to give them your vision. You are the leader of them, they're not the leader of you. Owner-operators, they often rely on them to be the leader. You are leading your group. So here's how you can do this. Here's how you can create this. And the phrase I like to use for this is you're building a family office level team. You're not buying a family office, you're actually building it yourself. And here's how you can do that. Number 1, You're going to create an inner circle wealth team, and it's going to be very similar to what I just said. Someone that's helping you with taxes or has a tax knowledge. It could be a tax strategist. Someone that helps you with your investments. Someone that helps you protect everything so that if the black swan events happen or occur, you are protected from it. And then someone that's helping you scale and use and grow your biggest asset, which is your business. That is your inner circle wealth team. Having them isn't enough. You need to have them in the same room 3 to 4 times a year. So they're talking and collaborating for you. You're the leader of you're displaying your vision of this is the wealth I want to have, this is the life I want to live, this is where I want to live, very much with what JP was saying is where are we going? You're telling them that, and then they're creating the plan with you to make it happen. So you're the leader, and they're running your race, not theirs. Now, I've created something, and this is actually in stark contrast to what Justin Nielsen said, so I'm actually breaking the rules with the QR code. But I've created a workbook that will show you who should be on your Inner Circle Wealth team, what questions you can ask them to make sure they're in alignment with your vision and goals, and then a list of all the different professionals that can potentially help you take your vision to the next level. So the first step of becoming an owner investor that I believe is most applicable to you is creating a world-class family office team that works for you and not for themselves. The second is tax optimization. Whenever I talk about tax optimization, is what occurs is questions like this start coming out. What's the best tax strategy? Or I heard this thing about trusts. And all of a sudden it goes from tax strategy to I'm chasing the next one to the next one to the next one. Everyone thinks that tax optimization comes from the tax strategy. But in reality, tax optimization is not chasing strategies. Tax optimization is building a tax structure within your business and personal financial life. Everyone wants the secret of how do I pay less taxes every year and what do I do? You build a system of structure in your life, and that system will produce the tax savings over and over again. To help you better see this, we're going to do a comparison again. We're going to compare the way an owner-operator or an owner-leader would behave in their tax situation, and then we're going to compare it to the way that an owner-investor would create theirs so you can see the stark contrast. First, owner-operators oftentimes have the mindset around taxes that I just want to save taxes to save taxes, or I just want to save taxes because I want to keep more of my money. Second, it's usually ran by one accountant. So even if this accountant is a part of a big firm, there's usually just one person who's creating all the strategies and compiling everything and making it happen. Because it's one person, they're usually extremely reactive. So they're not bringing things to the foretable. Maybe they're talking a little bit about maybe you should do the Augusta rule or you should pay your children. But it's surface level. Though those things are good, they're not comprehensive. They usually will ask for your data in November or December. And then if they offer really anything outside those basic things, they usually start talking about things like, can you go buy stuff? Is there a truck you can purchase? Is there a piece of equipment you can buy? Is there a program you can purchase? I talked with someone the other day, and they bought an RV because their accountant told them to. And it wasn't because they wanted the RV. They just did it because the accountant said it would help them save taxes. That is the surefire sign that you have an owner-operator accountant. They're not bringing things that are actually building wealth. They're just giving you stuff to buy. The crown jewel of the owner-operator accountant is the qualified plan, so things like the SEP or the defined benefit plan. The problem with defined benefit plans and qualified plans in general is that if you're building wealth right, you should have more money in the future, not less. And if you have more money in the future with a qualified plan, that means more taxes in the future. The only way qualified plans work is if you have less money in the future. And that stands in stark contrast to who you are. I doubt the people in this room are thinking, I want to have less money in the future than I do today. An abundance mindset stands or is at odds against a strategy that only works if you're shrinking. The next thing about owner-operator accountants is they're not helping you make your income passive. Everything is active, which means it's taxed at the highest rates, and then all of your insurance is commercial. If we are going to become owner investors, you have to go away from this framework. This framework will make you pay more taxes than you're supposed to on an annual basis, and it will not help you build wealth long term. So you have to shun it and move away from it. The movement you need to move into is becoming an owner investor, and it starts with number one, the mindset of shifting from I'm saving taxes to save taxes to I'm saving taxes to build wealth. Second, you're shifting from one accountant to a tax team. It's no longer just an accountant that's running your tax situation. It's an accountant, it's a tax strategist, it's tax attorneys, it's a registered investment advisor, it's a tax-smart insurance advisor, it's a tax specialist like a research and development tax credit specialist or cost segregation specialist, it's a private placement life insurance specialist. That's a robust group of people that are part of your planning, and you've shifted away from a one-person show that can't do and bring all that to you. Because you have a team doesn't really mean anything unless you're being proactive with them. Proactive planning looks like this. Once a quarter, you're meeting with your tax team lead and you're talking about how do I reduce my taxes? What is my bill going to be? How massive is it going to be? And what strategies can I do between now and the end of the year that can reduce that down to a reasonable amount? Once you're proactively planning with your team, everything is unlocked. Because you're no longer just buying stuff like the owner-operator. You're actually being really deliberate around your asset choices. You're purchasing assets that will reduce your tax bill, which are also building your wealth, which are going to appreciate and continue to build you that way. You're no longer reliant upon the qualified plan. The qualified plan went from the strategy to this is just an optional thing. In some years, it might be the right choice. In other years, it might. And I want to delay some taxes sometimes, but for the most part, I'm going to do other planning that's going to get it away faster. Your accountant, because you're buying assets, because you're proactively planning with a group of people that are helping you build your wealth, now more and more of your income is shifting to passive, which means it's taxed at a lower rate. And you're shifting more and more of your insurance from being commercial entirely to more and more of it looking like private insurance. This framework, this structure is how you save taxes. It's repeatable in any country. It doesn't matter where you're from. If you create this, you will save taxes over and over and over again for the rest of your life. If you choose to embrace this, you will pay far more than you should over and over and over again. Let me tell you the story of one of our clients that embraced this principle. So Aaron he owned a practice, a medical practice. He did about $3.5 million in that one location. We saved him about $160,000 in taxes. But because he embraced the mindset of, I'm going to save taxes to build wealth, he took that $160,000 and bought a second location 30 minutes away. In 1 year, that second location is now $1 million location. So his EBITDA went from $3.5 million to $4.5 million in 1 year. But now he had something proved to him. He proved to himself that my systems are repeatable. And now because he did that, he's now taking a program and creating a licensing program that's going to go nationwide. So he went from, I'm just doing well, to I use the taxes to accelerate my ability to grow wealth and change my entire trajectory. With things are looking like he's creating it's going to be close to $1 billion company when he reaches the end of it. And it was all sparked because he chose to save taxes to build wealth instead of save taxes to save taxes. Again, that same workbook, if you didn't scan it yet, I talk about how to build a tax team and how to create this structure in that workbook. The last thing that I think is vital for us to make, the last shift that I believe for us to start becoming an owner-investor, is to start thinking generationally. Owner-operators often operate in short time frames. It's 3 years, 5 years to age 65. This is one of the main contributors, I believe, is why many people don't actually build wealth, because they're putting a ceiling or an end date on their actual growth and progress. I believe that if we're going to embrace the owner-investor mindset, we have to start thinking generationally. There is no end to our ability to create. Our money can continue onward forever in an upward trajectory of impact. Let me tell you the story of how I learned this. This is George West. He was my grandfather, great-grandfather. He was a bomber pilot in World War II. He was as successful as a bomber pilot you could have. He had every award you could have ever earned at the time. He flew 26 successful missions. A week before D-Day, he was on a mission over Leipzig, Germany. This particular mission, he encountered heavy Nazi resistance. So much so that tragically, 2 of his in-plane gunners were killed. The plane was so badly damaged that he, despite all of his previous success, was unable to fly the plane back to Allied airspace. So he had to initiate emergency exit procedures. So one by one, he helped his crew find their way to safety. His bombardiers, his navigators, and finally his co-pilot. As he took those final steps to join his crew, the plane exploded. George West sacrificed his life for his crew, for his country, and for his family. My grandmother was born 1 month later. She never knew her dad. She only knew her dad by the impact of his actions. And it was those actions that have rippled through the generations into my soul. You don't have to sacrifice your life to leave a generational impact, but if you choose to have a short-sighted vision or a vision with an end date, so too will your impact end. But if you choose to become an owner-investor and think generationally, and to embrace the idea that you can have generational impact, that the money you're making doesn't have to ruin people, that it can be built on the foundation of impact, everything changes. You make bigger and bigger choices, which will make bigger and bigger impact. If we are going to embrace the idea that wealth is important, we have to embrace the idea that the wealth has a meaning. And to me, the wealth has a meaning when it's tied to impact. To become an owner-investor, you need to create a world-class family office team that you're the leader of. You need to become tax optimized, not by chasing the latest strategy, but by building a deliberate structure of tax systemization. And then you need to think generationally. We at Big Life Financial, we create owner-investors. This link, if you want to work with us, will give you a free complimentary opportunity to sit down with us and have a discussion on whether we can help you on that journey or not. And it's going to be no pressure. It's just going to be, can we help you and can we bring value to your situation? Whether you work with us or not, I want to leave an invitation for you. I want you to commit to something, because if we don't commit to becoming an owner-investor, then nothing's going to change. And so the one small commitment I want you to do is, if you're willing and you're open to the idea that I need to become an owner-investor, I just want you to stand up. Because if you're standing up, you're making that initial step into becoming that. It doesn't mean you're booking a call. It just means I'm going to take that step and I'm going to start to become this person. Because becoming the person is how you actually make the changes. It's your behaviors and habits. So if you are willing to do that with me, stand up with me and make that commitment to become an owner-investor. If you're standing, it means you've given yourself the permission to transform your generational income into generational wealth, which is most importantly the permission to leave a generational impact. I thank you for your time.
Thank you. That was powerful.